Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi everyone, thank you for tuning in for the second episode of Conversations with Your Advisor. Today we'll be discussing about whether complexity leads to performance on the portfolio. We'll discuss this by looking at an example of a client who came on board sometime around 2015. He had no previous exposure to equity markets and he started off with an investment of about 1 crore. And he kept a goal that by 2025 he should be at a 10 crore milestone. And when he started off, he was not very aware about the risk that he was capable of taking. He was not too aware about what instruments to invest in. So he started off basically by investing in mutual funds and taking very minimal risk on his portfolio. He obviously has been through a couple of market cycles and he's been through COVID as well, which kind of made him understand about his own client behavior in terms of how he reacts when the market moves a certain way and the amount of risk that he is willing to take and how he can participate in multiple opportunities that his advisor alerts him in. So today, with all that experience and understanding over the last 6-7 years, he is someone who has progressed and moved into few products like the PMS. And also, given that his wealth bracket has moved significantly, he has a lot of people in his social circle and also others from the industry who reach out to him for diversifying his investments across products. So, how does one go about managing this and handling their portfolio in terms of different products that especially come into the limelight today, like structured products, AIFs, and how does one still stick to growing their corpus and creating wealth in a more consistent manner? I'll just hand over to Samyukta, who will take us through this.
Thanks, Rashmika. I think that's a natural progression for most investors as they begin to see more and more wealth build through financial assets. You will have these products that show up in your inbox or from conversations with others, whether it's peers, whether it's other wealth managers, where you are exposed to many different products, right? And many of them are more complex in nature, and you begin to have access to this only after you cross certain thresholds in terms of your financial wealth. And when this happens, there is this nagging sensation for an investor that, maybe I need to move on to the next thing. Maybe I need to level up my investment strategy. And often the answer comes with complexity, because if you look at structured products, or if you look at overseas investments, or if you look at AIFs, there is a layer of complexity that goes into all of these products. Or even in the case of your investor where you're looking at a portfolio management service, that migration from a mutual fund to a portfolio management service or an AIF, definitely there is another layer of complexity that comes in, right? And while it's good to think about these things, I think every investor also needs to evaluate how this finally translates into performance for them. Because what tends to work on paper, and sometimes these returns on paper look phenomenal, and that's what actually draws people in, needs to be tested in the market. And often what you see is there is a gap between what you expect based on certain projections and what actually happens based on the market cycle. And more seasoned investors are obviously more familiar with how this works, and they know how to anchor their expectations to a more realistic number. But I think for somebody who's creating wealth and in that journey, if you've not seen too many market cycles, or if you've only seen specific kinds of cycles which could create certain biases, then you're not too familiar with what else could happen, right? So when it comes to these products, a couple of really good ways to evaluate and test is to know that complexity might entail a higher number of transactions. So whether that's the kind of philosophy you want to use for wealth creation is something you need to evaluate. Higher transactions may also result in more taxes. So what is the tax efficiency is something you need to ask, because each asset class has its own taxation rules and advantages or disadvantages. So migrating from one product to another product, you should also evaluate whether you're migrating from one asset class or taxation structure to another asset class or taxation structure, and whether the post tax returns are actually going to match up to what you expect. And the last thing, of course, when it comes to more complex products, is to evaluate the cost structure. Because if you're going to be profit sharing and the profit sharing is not really in your favor, or if the basic expenses on the fund management are going to be much higher, then that automatically eats into your wealth creation capacity, right? And most investors are cost conscious. They do evaluate the cost factor early on. But I think as it gets to more complex products, that is something that you need to pay more attention to, because given the nature of the structure, people are going to charge you higher because more work is going into these products. That being said, I think a lot of us find it difficult to digest that the principles of wealth creation kind of stay the same regardless of what wealth bracket you are in. And just to list out a few fundamental factors, I think discipline really matters, and that's something that came out in this client's wealth story, where they were very consistent in terms of contributing to the portfolio. I think setting milestones is also crucial, because wherever you are, you should know what is driving you to contribute to your portfolio, what is driving you to sort of be more disciplined, because knowing your vision is what is going to actually get you to the table to have that conversation with your advisor. I think the third thing is to look at asset allocation, because the market works in cycles, and at any point there is going to be an asset class that is performing really well, there's going to be an asset class where there's opportunity to grow, and you should have a mix of both in your portfolio, right? You don't want to be starting in the performing asset classes because your prospective returns are going to be lower, and you don't want to miss out on the ones that are really going to deliver growth. So this having a framework in terms of asset allocation really does help. And lastly, to look at risk management. I think there's a lot of hype around how you can't be a conservative investor and make wealth, and this is just a case that proves that you totally can do that. If you are a conservative investor, then you're already ahead on this. If you're an aggressive investor, you need to start paying a little bit attention to risk. And as long as we follow these steps, no matter where we are in our journey, I think you're going to do really well for yourself.
Thank you, Samyukta, for sharing those insights. So the key takeaways is that you need to basically first be very aware about the goals and milestones that you're setting for yourself. Understand the risk capacity that you have, and last but not the least, have the discipline and the habit of saving and growing your wealth and having conversations with your advisor. So while you might hear of many products or while you might hear of new things, I think it's important to make a very well informed decision. So have that conversation with your advisor to make a decision that is going to suit you the best, because something that might suit someone else is not necessarily what needs to be part of your portfolio. Thank you.